Every single month, you hand money over to an insurance company. Car insurance, health insurance, home insurance, maybe all three. And statistically, most of you will never get back as much as you put in. So, how is that a fair deal? And how are these companies making billions? Today, we are pulling back the curtain on one of the most profitable and most misunderstood business models in the world. Welcome to What the Finance. I'm Mickey. Let's go. At its core, insurance is a bet. You bet something bad will happen to you. The insurance company is betting it won't. And every month you pay them, win or lose. That payment is called your premium. And it's the foundation of everything we are about to talk about. But here is what most people don't realize. The premium you pay is only one of three ways these companies make money. And honestly, it's not even most interesting one. Let's start with obvious one. Underwriting profit. When you apply for insurance, the company doesn't just hand you a policy. They study you, your age, your health, your driving record, where you live, what you own. This process is called underwriting, and the people who run the numbers are called actuaries. Basically, mathematicians whose entire job is figuring out how likely you are to make a claim. Here's a simple example. Imagine 1,000 people all pay $1,200 a year for car insurance. That's 1.2 million collected. Now, the insurance actuaries predict that on average, maybe 50 of those people will make a claim. And each claim costs around $8,000. That's 400,000 in claims. 1.2 million in, 400,000 out, plus some running costs. That's a profit. This is the law of large numbers in action. No single person is predictable, but 1,000 people, pretty predictable. 1,000,000 people, very predictable. The insurer doesn't need to know your future. They just need to know the average future of everyone in the pool. And they price accordingly. Now, if they price too low, they lose money. If they price too high, you go to a competitor. Getting that balance right is the art and science of underwriting. Okay, now we get to the part that genuinely blew my mind when I first understood it way back in college. It's called the float, and it's the reason Warren Buffett, one of the richest people on earth, once called insurance the most important business at his company, Berkshire Hathaway. Here is the concept. You pay your premium on January 1st, but the insurance company doesn't pay out any claims on January 1st. They pay them whenever something bad actually happens, which might be months or even years later. So, in the meantime, what happens with your money? Obviously, they invested. Every single premium collected from every single policyholder sitting in a giant pool, being put to work in stocks, bonds, and real estate before a single claim is paid. This pool of money is the float, and for a big insurer, we are talking billions of dollars being invested at no cost to them using your premiums. Buffett himself said the float is money they hold but they don't own. And because they are collecting it before they have to pay anything out, it's essentially a free loan from every policyholder that they get to invest for their own benefit. At Berkshire Hathaway, the float reached 171 billion in 2024. 171 billion dollars invested, generating returns, all from premiums people paid before a single claim was settled. This is not just a revenue stream, that's a machine. So the float leads directly to the third revenue stream, investment income. Insurance companies are some of the biggest investors in the entire global economy. They buy government bonds, corporate bonds, stocks, real estate. In 2024 alone, property and casualty insurers in the US earned a record of 89 billion in investment profits. Not from selling policies, from investing the money those policies brought in. So when you think about what an insurance company actually is, it's not just a safety net provider. It's an investment firm that happens to sell policies to fund its investment activities. Think about that next time you get your renewal notice. Here is a quick bonus fact that breaks most people's brains. Insurance companies buy insurance. Yes, really. It's called reinsurance. When a catastrophic event happens, for example, a major hurricane, an earthquake, a pandemic, the claims can be so large that even a big insurer could struggle to pay them all. So insurance transfers some of that risk to other companies called reinsurers in exchange, yes, you guessed it, premium. Insurance for insurers. It's turtles all the way down. So, what does all of this mean for you sitting at home paying your monthly premiums? A few things actually. One, insurance is not a savings account. The entire model is built on the fact that most people pay more in than they ever get back. That's not a scam. That's the point. You're buying protection against catastrophe, not a return on investment. Two, shopping around actually matters. Because underwriting is competitive, different insurers will price your risk differently. Getting multiple quotas can save you real money. Three, understand your deductible. That's the amount you pay before the insurer pays anything. A higher deductible, lower premium. A lower deductible, higher premium. Choosing the right balance for your situation is one of the simplest financial moves you can make. And four, now you understand why Warren Buffett loves this industry so much. The float is genuinely one of the most powerful financial mechanisms ever invented. And now you know what it is. Insurance used to seem boring to me. Now I think it's one of the most brilliantly engineered business models in history. If this video made something click for you, hit that like button. It generally helps the channel more than you think. And if you want more, wait, I never knew that moments about how money actually works, also subscribe. New video coming soon. I'm Mickey, this is What the Finance, and see you all in next video.